Hey traders, Jason here from Levitt Brothers. So in this video, I'm going to look at a few quant studies that hopefully can guide us the rest of the year. April's in the books. We had a 5-month win streak. November, December, January, February, March, all up months. April, a down month. No big deal. 5-month win streak, broken. It's not the end of the world. So I want to look at what does the market tend to do after a down April? What does the market tend to do based on breaking a 5-month win streak, based on how the market has done so far this year? Just let's go look at a few studies. All right, so first off, this is the S&P 500 monthly chart. And you can see really good rally, big kind of cup and handle pattern, breaks out and rallies up to an all-time high, several months in a row, all-time high, all-time high, all-time high. And now we have a down month, no big deal. The S&P could definitely fall further for a month or so and not destroy the overall structure and bullishness of this chart. A lot of traders fall in the trap of zooming in way too close, and they think the sky is falling just because we had a down month. But then when you look at a chart like this, you realize, hey, it's a down month after 5 down months. It's not a big deal. The overall structure is still very good. So that's what we're working with right now. All right, let's go through some studies here. All right, so here are the May through December average returns as a function of a down April. Okay, and this is compliments of Brown Technical Research. So after you get a down April, on average, May tends to be a little bit on the weaker side. June tends to be a little bit on the weaker side. You get a bounce in July. And then August is a pretty good down month, and September is a huge down month, but then we finish the year very strong. This is just based on a down April. For whatever reason, we could come up with certain reasons of why that would be the case. April is the last month of the best 6 months of the year. Who knows? But based on a down April, and this year April was down, I think, about 4.2%. This is what typically happens. You have, generally speaking, you have weakness for several months, but then a really strong end of the year. All right, next. This looks at how the market tends to do from May until October. Okay, so that's the weaker 6 months of the year, as a function of how the market has done at year to date at that point in time. Okay, so when the market is up January, February, March, April, positive year to date, the market tends to be up 76.1% of the time with an average gain of 4% for the following 6 months. When the market is down those first 4 months of the year, the market looking out 6 months is only up 46% of the time, so not even 50%, and the average return is minus 2.3%. Okay, this year the market was up, I think it was 5.6% as of right now. I'm recording this after the close on April 30th. The market is up 5.6% year to date. So that firmly puts us into the positive one. But then we have another one over here that says when the market is up even more, more than 4%, which is where we're at, the odds are still very good. Okay, 77.5, a little bit higher. 77.5, not chance, but 77.5% of the time the market has been higher, and the average gain has been about 4.2%. Okay, so this just kind of tells you that even though we're heading into the weaker 6 months of the year, based on the fact that the market is up 5.6% year to date, odds are pretty good that the market's going to be up 6 months from now with, and this is the average gain of 4.2%. All right, so not too bad. All right, so here is some numbers from the Trader's Almanac. These are election year drawdowns, basically since the early 50s. Okay, so you can see here's 1952. We had a 6.85% drawdown. 4 years later, in 1956, we had a 10.78% drawdown. Okay, so there's going to be a drawdown. The average drawdown since the early 50s has been 13.07%. This is pulled down by a negative 48% there and a negative 34% there. If you take those out, then it's, this 13.07 is not as bad. the point of this is just to remind you that like it's very normal in an election year to have a decent pullback. Okay, that's very normal. So far, as of now, these stats are as of a couple days ago. As of right now, our max pullback is about 4%. Okay, as of like 2 weeks ago, the low of 2 weeks ago, we had a 4% pullback. Okay, that is one of the smallest and shallowest pullbacks we've had since, over the last 70 years. So even if the market legged down again and dropped another 4 or 5% below the low of 2 weeks ago, that's still pretty shallow and pretty mellow by historical standards. If anything, it just puts it in line with what is normal. Okay, so it just kind of puts in perspective. We just had a really weak April, but compared to history, the pullback we've had is actually not a big deal. It's actually one of the smallest we've had, and we could even pull back. We can double up the pullback, and it would still only be average relative to history. Okay, so if we get another pullback, don't panic. Okay, don't panic. It's pretty much it's normal. All right, this chart from the Trader's Almanac shows us the average path the S&P follows during election years, which is the black line. The green line is the top are the top election years. I don't know what percentage the top. I don't know if it's like top 10%, top 20%, but those are the top years. Okay, and you can see the red line is this year. The red line tracked the green line pretty closely up until about here, and then we had a little bit of a blow off in late March, and now it's it went up more than the green line, and then it fell in April more than the green line. So it's actually more like this because this chart was taken 2 weeks ago. So the purpose of this, again, is to remind you, to put in perspective that even during a strong year, and again, this is election year, it's pretty normal to have a weak April, which we just had, and followed up with a weak May, which, May starts tomorrow. We don't know what's going to happen. But it's just it puts in perspective that it's pretty normal to have a weak couple of months, and then the uptrend can resume and do well for the rest of the year. The market's not going to track this exactly, but it serves as a reminder that if we have some weakness going into next month, don't panic. Don't assume we're going to go, fall into a bear market. It could happen, who knows, but odds are, election year, odds are it's probably not going to happen, at least based on the historical averages, so just keep it in mind. All right, last one. This is from Wayne Whaley. This is I know it's a lot of numbers here, but this is what happens after a 5-month win streak ends. Okay, so here you had in 1950, you had a 5-month win streak, like 1, 2, 3, 4, 5. Those are your 5 up months in a row. Month number 6, it was down 5.8%, and then it shows you what happened the following month, what happened the following quarter, and what happened 2 months out or 2 quarters out. So what I want to look at down here are the averages. Okay, 1 month out when this happens, and I'm showing this to you because this is what just happened. The market moved up November, December, January, February, March, and then it just moved down in April to break the winning streak. So 1 month out, the market is up 22 times, down 8 times, and the average, I got to get rid of this, and the average gain is about 1.9%. Looking out 3 months, the win-loss is 25-5, and the gain is about 3.9%. And looking out 6 months, the win-loss is 27-3, with the average being about 9%. Okay, so you get a 5-month win streak. That's great. The win streak breaks with a down month. No big deal, because looking out 3 months, 6 months, since over the last 70 years, many more times than not, the market has posted a pretty good gain. All right, so the sum of all this tells us that we could have some weakness over the next month or so, but everything is still in line to do well looking into the fall and into the end of the year. Okay, if you're a trader, if you're a swing trader, you should love it if the market was weak, because then you get to buy quality stocks at a discount price, and then you get to make big returns. Okay, if a stock is at 100 and it's going to be at 120 at the end of the year, let's say you could look into some crystal ball and see that it's 100. Would you want to buy it at 100 right now and ride it to 120? Or do you want to buy it at 80 after a summer dip and then ride it to 120? Okay, weakness in the near term provides an opportunity to buy stocks at better prices and nail bigger returns going forward. So if we have some weakness in the near term, don't panic. Things are still in line for doing well into the end of the year. All right, hope you got something out of this, and I'll see you next time.